Okay, let's dive right into this. Welcome to today's Explainer, where we're pulling back the curtain on a massive, hidden mechanical failure in the global finance system. We're going to explore a quiet, yet absolutely radical structural shift that is happening right under our noses. Basically, we're talking about the collision of traditional private equity, the massive, explosive growth potential of the African continent, and the quiet ascent of European patient capital.
$3.8 trillion. Take a second to let that number sink in. Right now, there is a $3.8 trillion backlog of unsold companies completely trapped globally in a massive private equity bottleneck. It's a total systemic failure. And to really understand why European family wealth is quietly pouring into Africa to bypass this exact bottleneck, we first have to tear down the traditional Wall Street playbook.
So let's start with Section 1, the 10-year fund fallacy. Or, as it's perfectly subtitled here, the ticking clock destroying enterprise value.
Now, you might be familiar with the standard, closed-ended limited partnership model that institutional capital has relied on for decades. It's a very rigid 10-year life cycle. You've got a 5-year investment period and then a 5-year harvesting and divestment period. But here's the massive structural flaw. It creates an artificial ticking clock. If a fund hits year 10, managers have a mandatory obligation to sell the company and return capital to their limited partners. It literally doesn't matter what the market is doing, they just have to sell.
And you know what? That ticking clock is absolutely devastating in emerging and frontier markets like Africa. Imagine you have a highly performant, cash-generating portfolio company, but suddenly, boom, there's a macroeconomic shock. Maybe it's rapid local currency depreciation, a sudden supply chain blockage, some temporary political disruption, or just persistently high global interest rates. If a manager is forced by their strict 10-year mandate to sell a prime asset during one of these temporary downturns, they lock in severe losses in US dollar terms. Forcing a sale during a cyclical dip doesn't just hurt returns, it actively destroys the company's fundamental value. Now, what's really interesting is how the industry tries to handle this. Because traditional funds are stuck with mature assets that they just can't find outside buyers for, they've resorted to this wildly controversial tactic called CV squared, or continuation vehicles. It's essentially a liquidity mirage. Managers create a brand new fund simply to purchase assets from their own older funds. It's a perpetual illiquidity loop used to mask depressed asset values and put off an inevitable market reckoning. Wild, right?
I absolutely love this quote from our sources because it hits the nail on the head. Traditional private equity is basically like flipping a house on a strict deadline. But this European money, it's more like planting an oak tree. Wall Street's frantic, exit-driven pacing is just fundamentally misaligned with the realities of building robust, lasting businesses in frontier markets.
So this brings us to a really vital question. If the traditional model is fundamentally broken, how do we escape the ticking clock? Where is the capital that actually aligns with the cyclical realities and the massive demographic growth of Africa? That brings us perfectly to our next section, the patient capital advantage. This is all about European private wealth and the indefinite holding period.
We are currently seeing a profound shift away from those institutional limited partners we talked about and a move towards European single and multifamily offices. Unlike institutional capital, these family offices operate entirely without the artificial constraints of defined fund life cycles. They are acting exactly like that oak tree, managing multi-generational wealth established by successful entrepreneurs and prioritizing compounded growth over decades rather than stressing over quarterly performance. So the crucial point here is that an indefinite holding period is definitely not a recipe for lazy management. It's actually a highly strategic shield. It gives African portfolio companies the runway they need to weather those sudden macroeconomic downturns. It gives them the breathing room to execute long-term, capital-intensive infrastructure programs and then patiently wait for optimal, highly lucrative exit windows, all without the destructive pressure of a forced divestment.
Let's move on to the actual financial mechanics in our next section. Bypassing onerous fee structures, specifically the rise of direct deals and SPVs. And this brilliantly illustrates one of the absolute biggest frustrations with traditional PE, the standard 2 and 20 model. That's a 2% annual management fee on committed capital and a 20% carried interest on profits. In a frontier market, this fee drag is just way too heavy. It severely dampens the net internal rate of return. So European family offices are increasingly looking at this and just saying no to traditional blind pool funds. Instead, what they do is opt for direct co-investments using special purpose vehicles, or SPVs. An SPV is a dedicated entity set up to hold a single investment alongside a lead sponsor.
By isolating the risk to one specific deal, it keeps the cap table incredibly clean, allows for highly tailored tax and governance details, and crucially, it completely bypasses those heavy traditional fund fees. This is a real game changer for preserving the compounding of generational wealth.
And African fund managers are getting incredibly smart about how they actually access this European wealth. Look, setting up a fully compliant EU fund under AFMD is insanely costly. So agile managers are finding a backdoor. They leverage specific targeted local rules, known as national private placement regimes, to market directly to family offices on a country-by-country basis. Whether they are targeting Germany, the UK, or the Nordics, this efficiently bypasses the heaviest red tape while still unlocking massive pools of capital. Okay, so we know how the capital moves. Let's look at our final section, compounding true generational wealth. This is all about operational value creation over financial engineering.
The traditional private equity playbook, as we know, often relies heavily on leverage. It's debt-fueled financial engineering designed to juice the numbers for a quick sale. But in frontier markets, where debt is really expensive, that playbook completely breaks down. True value comes from rolling up your sleeves and getting your hands dirty. European family offices, drawing on their own entrepreneurial roots, want to build fundamental business value. They do this by actively improving supply chains, growing top-line revenue, and optimizing margins over decades.
But to attract this kind of premium capital, African managers have to step up to a rigorous new governance paradigm. Family office chief investment officers absolutely will not accept reputational risk. They demand flawless, institutional-grade reporting. They align with strict European sustainability frameworks, like SFDR Articles 8 and 9. This means verifiable green initiatives and social uplift aren't just nice-to-haves anymore. They are absolute preconditions for getting the money. And importantly, they demand that managers have significant personal skin in the game to prove their interests are truly aligned.
So what does this all mean? It boils down to a single, undeniable truth. True wealth in frontier markets is generated through patient, operational value creation, not artificial financial engineering. The whole structural architecture of global private markets is evolving right now. The future in Africa belongs to the sophisticated alignment of multi-generational European wealth and deeply operational African expertise. So, I want to leave you with this final provocative thought. As that massive $3.8 trillion bottleneck continues to completely break the traditional 10-year private equity model, will your capital be trapped by a ticking clock, caught in a perpetual loop of forced sales? Or will it be liberated as patient capital, building real value and compounding for the next generation? Something to really think about. Thanks for joining me for this explainer, and I'll catch you next time.